Hi there, and welcome to Industry Innovators. My name is Nicole Carey, and I'm a senior HR consultant with the HR Advantage. Today, we're diving into a very timely topic, and we're talking about holiday bonuses versus gifts, what's fair, what's effective, and how to make sure your year end appreciation actually hits the mark. So, like I mentioned, my name is Nicole, and I'm an HR consultant with the HR Advantage. And we're a team that takes care of HR payroll, health and safety, and compliance so that business owners can focus on actually running their business. We don't just hand over templates or throw out legal jargon. We really like to roll up our sleeves and work alongside our clients so that they can get real results. Our goal is quite simple. We take HR and compliance off your plate and handle it proactively so that you're never stuck with surprises or last minute scrambles. All right, so every holiday season, employers want to do something a little extra for their teams. It might be cash, might be a gift card, it's maybe a turkey or a jacket. That's great, but the problem is not everything is treated the same when it comes to taxes. So some things might be considered a taxable benefit where your employee has to pay a tax on it, while others are not. And so this guide will hopefully help break things down to the basics so that you don't get caught off guard at year end. So a taxable benefit is anything extra that you give your employee that actually has a dollar value. And if it's something that they can use personally, not just for work, the chances are it's taxable. This means that the employee pays tax on it as if it was income, cash in their pocket. So you as an employer have to report it on their T4 also. So some examples of taxable benefits include cash bonuses, gift cards, personal use of a company vehicle, maybe a gym membership that's paid by the organization. Some of those perks can be taxable benefits. Non-taxable benefits can include non-cash holiday gifts under 500, like jackets, tools, turkeys, staff parties if the cost is reasonable, and any work-related training or safety gear. So a general rule, if it feels like extra pay, it's probably taxable. If it's a one-off gift or something that's not technically or something that is technically tied to the job, it might not be taxable. So cash, always taxable. Always, always, always. If you hand someone $200 at Christmas, that is considered employment income and it should go through payroll with tax, CPP, EI, and all those stat deductions taken off. Gift cards are also taxable. They are considered cash as well. So even if you think that a $100 gift card is just a gift, the CRA will treat it like cash because it can be spent. That means it's also a taxable benefit, has to go through their T4, and it's subject to stat deductions as well. So here's an example. If you pay someone a $500 holiday bonus to your top worker, feels like a nice gesture, but payroll also has to deduct tax. So the employee might only see $400 on their check. Now they still have to reconcile at the end of the year and file their taxes and things like that. But that is what technically is supposed to happen is those deductions need to come off. So for non-cash gifts, CRA has special rules that are non-cash and non-gift card. So this is where you can save both yourself and your employees some tax headaches. So employers can give up to $500 worth of non-cash gifts per year per employee without it being taxable. Some examples would be like jackets, tools, electronics, or even a turkey. If you go over the $500, the extra is taxable. So if you give a worker, say every new worker, sorry, if you give a worker a new set of insulated coveralls worth $300, not taxable. But if you also give them a $300 tablet, you're now at $600. So the first 500 is tax free. The extra 100 has to be reported as a taxable benefit. So in terms of meals, parties, and events, think about your holiday party. The CRA allows you to hold an annual staff party like a holiday dinner, and that is not taxable as long as the cost is reasonable. I'm not an accountant. Based on what I found online, that's kind of around that $150 per person or less. So if you hand out door prizes, raffle items, those may fall under the $500 gift rule that we talked about earlier. Here's an example we can walk through. So you rent out a hall, you provide dinner, everyone gets a turkey at the end of the night. The meal is covered, and the turkey is part of the non-cash gift rule. So technically, that example of a holiday party would be non-taxable. Okay, so what can employers write off? So cash bonuses, it's a business expense for you, it's taxable for the employee. Gift cards, it's the same as cash, so deductible for you, taxable for them. Those non-cash gifts, so the under $500, it's deductible for you, tax-free for them. Parties and meals, it's deductible up to 50% of the cost for you, the same as any other meals and entertainment you might claim, but it's not taxable for employees if it's reasonable. Another important note here is that if you are a small incorporated business and you are also on payroll as an employee, business owner, and on payroll, these rules apply to you as well. You can't just sidestep the tax benefit rules because you're a business owner, unfortunately. So here's why leaders need to know what happens when it comes to holiday parties and everything that goes along with it. Supervisors and managers should understand the rules too, because they are often asked about bonuses or any sort of perks or benefits. And it really helps leaders answer if they confidently understand what the implications are, not only for the business, but for the employees as well. Anyone who manages people should know the difference between a gift that shows appreciation and a bonus that's taxable. Encourage leadership to explain it straight. So if it's cash or gift card, the government taxes it. If it's jacket or a turkey, not. Professional development and payroll basics makes your team leadership so much stronger. It prevents confusion and frustration, and it can build a lot of trust. Your payroll or admin person should also have a really good grasp of these rules for administering payroll. When in doubt, check with them or check with an accountant. Things can get really complicated really fast, especially if you're doing multiple things for multiple employees, or if you're doing multiple things a year. So if there are a number of benefits to deal with, really make sure that you have a good grasp on the rules. So going over the top 5 mistakes that we see our clients making. So one, thinking gift cards are gifts. They're not, they're cash. So a $100 gift card to Canadian Tire Tim's feels like a gift, but CRA says it's cash, so it is taxable. Skipping payroll deductions is another big mistake that we see. So again, if you're handing out cash bonuses or a check at Christmas time, it's quite common. But if it doesn't go through payroll with those statutory deductions taken off, income tax, CPP, and EI, you could be on the hook later. The next mistake we see is not tracking that $500 gift limit. So again, if you give a $300 jacket and a $300 tablet, that first $500 is fine, but the extra $100 is taxable. And if you don't track it, you can miss reporting it and you could be in big trouble later. The fourth mistake that we often see is forgetting personal use of company property. So a work truck, a work phone, or work tools that are used at home may count as a taxable benefit. If it's not strictly for the job, CRA may want it reported. I would recommend reaching out to an accountant if that's the case for your organization. And then the last one we see is mixing up a deductible versus non-taxable. So just because you can deduct something as a business expense doesn't mean it's tax-free for the employees. There's a really big difference there when we're talking about employee versus employer, deductible for a business owner, and then taxable for the employee. So as a bit of a wrap up, holiday gifts and bonuses are a great way to thank your team, but the tax side can get really tricky. The key thing to remember is cash and gift cards are always taxable. Non-cash gifts up to $500 are tax-free. Meals and parties are not taxable if they're reasonable. But you as a business owner can write off most of those expenses. However, that doesn't mean that it's tax-free for your crew. So it's really important to understand the implications of that your employees might face for your choices and spending. At the end of the day, it's not about how much you spend on your employees, but it's about showing your team that you appreciate them in a really genuine way. So do it right and keep the goodwill going all year without creating a year-end payroll mess. So appreciating your staff at the end of the year around holiday time is a really great way to build loyalty and boost morale, but only when it's done thoughtfully. So just understand the implications of whatever you're deciding to do with your team, and you'll be good to go. I want to thank you all for joining us today. So if you have any questions or if you'd like to continue the conversation, you can reach out to anyone on our team at hello@hradvantageservices.com or check out our website for more information at hradvantageservices.com. Mackenzie and I loved connecting on LinkedIn. So if you're ever on there, hit us up. We love keeping the conversation going over there. Thank you so much for joining us today. We're happy to help you celebrate your team in the right way, and I hope you get some useful tips from this presentation. Thank you for joining.